Andrew Malcolm here, Mortgage HQ. Now, if you're thinking about investing in property anytime soon, it's a high chance you're going to be investing in a high inflationary environment with high interest rates. So the $1 million question is, how do you invest in a high inflationary time with high interest rates? Especially when you've got this anchor in your mind about low interest rates and low inflation, which is what we've experienced in the last 5 or so years. So I think the thing to remember with inflation is that good debt is good, and that what you really want to do to protect your capital is allocate it into smart investments, and you want to borrow money and you pay it off later. And that is going to help you hedge against the negative aspects of inflation. So let's say you're looking to buy $1 million property, you've got a $200,000 of cash, and you're going to get an $800,000 mortgage. Now, your $200,000 of cash, if you don't allocate it, if you don't put it into property, it's going to sit in your bank account earning interest, but that interest is going to get taxed and it's probably going to be less than inflation. So the value of your $200,000 is going down over time. If you allocate it into a property, firstly, we will consider the interest rates in a second, but what you're doing is you're getting leverage on your money. So you're getting returns on the $1 million price. So you're getting $800,000 of extra leverage on your $200,000. Now, that is how you're protecting against the downside of inflation eating away your cash. Now, the interest rate is another thing. Now, if the interest rate is say 8% on that 800,000, how do you afford to borrow that money? And that's where it comes down to really understanding the yields and maybe potentially teaming up with other investors, friends or family, to make sure that you've got the borrowing power to afford those higher interest rates, and you've got reserves so that you're not overextending yourself. So you've got a period without a tenant or without income, that you're not getting struck by the high interest expense and losing that property through mortgagee. So if you need to invest with others, then great. You really need to understand the yield of properties and factor out best case and worst case scenario, and understand what it's going to look like in 12, 24, 36 months. Do your projections. And how successful property investors have done well in these times is through getting property under contract and settling in a year or two. Now, that might be quite hard for your everyday investor to get around to, but if you can put a settlement date 6 months in the future, then you're getting the benefit of today's price, and inflation is working in your favor, pushing up the value of that property. Now, that only works in a market where property prices keep going up, so you need to understand the risks associated with getting something under contract unconditionally and paying for it 6 months later if the market goes down. But if you're confident in what you're buying and the market is going up, by delaying for a long term, then you're actually getting benefits. And what you often find is that investors in a high inflationary, high interest rate environment are your really savvy investors that are finding properties for sale by sellers that are either distressed or they can't figure out how to charge more and get the high yields they need to be able to afford to keep those properties, especially when they're highly leveraged. So investing in a high inflation and high interest rate environment requires knowledge. You need to be brave, you need to understand what you're doing, and you just need to make sure that your cash flow is strong. You don't want to get in a situation where you're missing payments, because then it's going to all unravel before you're able to really take advantage of the gains. With a high inflationary environment, one thing you can be pretty sure of based on historical evidence is that in 10 years time, especially in a high inflationary environment, the property values are going to be way higher than they are today, but the debt isn't. And that's the important thing to remember. If we buy a $1 million property with $800,000 of debt today, in 10 years time, that's worth $2, $3, $4, $5 million, especially with a high inflationary environment, but the debt hasn't grown. So let's say we get to $3 million of value for our 1 million property in 10 years, that even if you don't pay a cent off on your debt, you just do interest only on that $800,000 for 10 years, then what you've done is you've gained $2 million of equity on that property just for the benefit of holding it, and we're not even factoring in the positive cash flow. So even if it's slightly negatively cash flowed, it doesn't matter as long as you can afford it, because we're getting that gain from inflation. So these big inflationary numbers, these big interest rate numbers, they confuse and scare people, which means the savvier investors can come in, take advantage of these opportunities. So personally, I feel the best time to invest is in high inflation, high interest rate environments, because that scares away all of the people that aren't actually serious about learning how to take advantage of these situations. So if you got any questions about interest rates, inflation, or just investing in general, let us know below and subscribe.